Hey, what's up everyone, and welcome to the School of Personal Finance. In today's video, I'm going to talk about that safe, less risky portion of your portfolio. So when you say I have an 80-20 portfolio, what you typically mean by that is that 80% of your allocation is invested in stocks and riskier types of assets, and 20% is invested in safer, less risky types of assets like bonds. But with interest rates hovering around 1% on the 10-year treasury, right now, that safer portion of your portfolio might be more at risk than you are aware of. So in this video, I'm going to try to help open your eyes as to what those risks might be and show you that it might not be as safe as you really think. All right, let's get to it. All right, so when we think about ultimate safety, the first thing that comes to mind is going to be like a savings account or a money market account that's FDIC insured, or a CD in the bank. And unfortunately, people who are afraid of taking risks, who are afraid of investing, this is where they save their money for the future. And it's just a losing proposition, especially right now with interest rates where they are. So if you have a money market account where you're earning a high yield, which is like 0.5% right now, with inflation around 2%, your money is going down in value by about 1.5% per year. And with the current monetary policy of the government just printing money and flooding the system with liquidity and buying assets, inflation is just going to continue to creep up higher, and the value of your savings are going to continue to go down. So even though it feels good and it feels safe, in reality, it is very risky keeping all of your investable assets in cash. In my opinion, there's really only two reasons to have a decent amount of cash on hand. The first one is you want to have an emergency fund. So you want to have money there in case something happens, you lose your job or whatever it is. You want to have enough liquidity that you have cash there to keep your life going. And the second thing is for dry powder. You want to have some dry powder in case we do get a pullback in the market. If something happens, you're able to deploy that money. So the savings account, it's just a holding place to eventually deploy it. Now, if you have short-term goals where you're going to need cash and you're saving money, like if you want to buy a house 3 years from now, then yes, a money market account is a great place to do that, or a short-term CD, savings account, because you know that money's earmarked in the short term and you don't want to have it at risk towards any big fluctuations. But other than that, you don't want to have large amounts of money sitting in a savings account where you're earning 0.5%, where it's just going to continue to be devalued by the money printing and by inflation. You know you have a guaranteed loss right now by having money in the savings account. And just to throw my disclosure in here, I'm not giving you specific advice. This is just my opinion. It's for entertainment purposes only. Please do not make any investment decisions based on anything that I'm saying to you, because obviously I do not know anything about you, so I cannot be giving you specific advice. All right, so now after cash and savings and CDs, the less risky portion of an asset allocation is typically made up of bonds and bond funds. What is a bond? A bond is just when you lend money to a company, to the government. So say, for example, the government is issuing 10-year bonds. You're going to give them, let's say, $1,000, and they're going to give you a piece of paper with an IOU, and they're going to pay you interest over the course of those 10 years. So all you're doing is you're letting the government borrow your money, do whatever they want with it, and then they're going to pay you back, and they're going to pay you interest along the way. So now you could have short-term bonds, intermediate-term bonds, long-term bonds. You could have government bonds, corporate bonds. You could have municipal bonds. So there's many different types of bonds out there that you might own in your portfolio. When interest rates are going down, the value of your bonds go up in value. And it's very simple if you take a step back and think about why this would be. Say, for example, the government issues you a bond and it pays 5%. Let's say that it's a 10-year bond, that this was a long time ago, and you're able to buy a 10-year bond at 5%. Now, bonds pay 1%. So would you rather have a bond from the government that's going to pay you 5% or 1%? Obviously, you would rather have one that's going to give you 5%. So as the interest rates start to go down from 5% to 4% to 3%, your bond that you're holding that has a 5% interest rate is worth more. You could sell that to somebody for more because they're going to get 5% once they buy it from you. So they would be willing to pay more for your 5% bond than they're going to pay the government for a 1% bond. So as interest rates go down, your bond becomes more valuable because yours pays 5%. And we've had a great bull run in the bond market because interest rates have been going down for like 30 years. So as interest rates go down, these bonds and these bond funds, the value of them are going up during this. But now, how much lower can it go? So we've been saying that for a few years, and they have continued to go lower. But we're basically at the point where the federal funds rate is 0, the 10-year treasury is 1%, so there's really not much room for bonds to go down even further so that the value of them goes up. So now we might start experiencing the opposite. So back in August, the 10-year treasury hit 0.5%. And now it's a little bit over 1%. So bonds have started to creep back up. But what if they go to 2% and 3% and 4%? If they continue rising, then the value of your bonds and your bond funds are going to go down. The hard part is that there's nowhere to really go for safety. Like I just mentioned with cash, it's not safe anymore. You're going to lose money as inflation goes up and the rates are so low. Your bond funds, they could definitely lose money. If you buy individual bonds, then you could keep it until maturity. So if you buy a 10-year government bond right now and it pays you 1%, you could keep it for 10 years. You don't have to worry about the value of your bond losing money because at the end of 10 years, they will give you your money back, but you're only going to earn 1%. So 1% is not going to get you where you want to go 10 years from now. It's not even keeping up with inflation. So it's a risk. And what has happened is everybody's been forced into buying riskier assets to try to get yield, to try to get a higher rate of return, because we can't all sit in 1% government bonds and hope that we're going to be able to afford things and retire comfortably 10 years from now. So now with this risk in bonds, do I believe that you shouldn't own any bonds? No, I don't believe that. I still think that you need to have a very well diversified portfolio and that bonds need to be a part of that. We just don't know what's going to happen in the future. So they still will provide a safety net if the market really goes down a lot, because bonds are not going to be anywhere near as volatile. But with that being said, they're not going to perform like they did the last 10 years. There's just not enough room for rates to go down. So what are you supposed to do right now with that conservative part of your allocation, especially if you're approaching retirement or if you're in retirement and maybe you have a 50-50 allocation? That's 50% of your money that's subject to the risk of interest rates going up and the value of your bond portfolio going down. And my answer to that is you really need to be very well diversified right now. It's more important than ever because we face so much uncertainty as far as monetary policy goes, these interest rates, the printing money. There is a lot of uncertainty of what's going to happen with inflation and how we're going to keep it all together. So by having a very well diversified conservative portion of your allocation, in my opinion, that is the best way to approach it. So that might mean having some short-term bonds, short-term bond funds, some intermediate-term bonds, some long-term bonds, but not much really. Having some corporate bonds as well as the government bonds, having some treasury inflation protected bonds so that if inflation goes up, the value of those bonds will go up as well. Also adding different types of asset classes in, like preferred stocks is another one that you could add in, where it's almost like a hybrid of a bond where it could be converted into a stock depending on the price of the stock, but they pay higher dividends and higher yields than the individual stock would pay. And then even getting into dividend paying stocks and more conservative types of stocks like utilities and consumer staples, and having that be a portion of your conservative allocation. It's kind of the direction that we're being forced into with interest rates being so low right now. But overall, the risk spectrum going out, it's just become more risky to invest in anything, but it's also very risky to hold cash. It's just very hard right now to get any kind of income or yield out of a portfolio without taking more risk because the interest rates are so low. And then even diversifying beyond that into like precious metals like gold and silver, which might not correlate with the rest of your portfolio. And then even international bonds and even international currencies as the value of the dollar, continues to drop. So being very well diversified, that really is my best advice for that conservative piece of the portfolio. But just realize that nothing is safe anymore. I don't know where you could really invest that you feel really good and safe, because if you invest in the bank or cash, CD, money markets, you're losing out to inflation, and inflation might continue to go up. If you invest in the markets, then obviously you're at risk at whatever underlying security there is or the volatility of the markets. Like if you're choosing dividend stocks to take a piece of that conservative portfolio, they're going to go down when the stock market goes down. Like when we had a drop in March, dividend stocks, they did get hit as well. So it's just very hard to have that piece of your portfolio where you really feel good about it. It's different than 20 years ago when interest rates were, much higher and you could just invest in CDs or buy a bond and hold it for 10 years and know that you're going to get 6 or 7% on it. Those days are long behind us and the future is uncertain. The last few years, it's been the growth assets. The growth assets are what's taken us higher and what's really provided everything. And That might continue, it might not, but we just don't know what the future is going to look like. So my best advice is diversify as much as you can. Now, if you're young, if you're not worried about this stuff and you have, 30 years to go before you're touching the money, then I really wouldn't want bonds in my portfolio. I would much rather be investing for growth, go with the ups and downs in the markets. I might include some alternative asset classes like the metals or like Bitcoin or something along those lines. But holding bonds right now, it's not appealing to me if I have a very long time horizon. It's those people that are approaching retirement or that are more conservative, that have a lower risk tolerance, that don't like the ups and downs of the market, or that are retired already, that are in, a pretty ugly predicament right now where it's just tough to get any kind of yield and be able to sleep well at night. All right, everyone, that is it for this one. I hope that you found that helpful. Please make sure to hit that subscribe button. If you've not subscribed to the channel yet, hit that like button if you enjoyed this video, and I'll see you again next week. Thanks.